I will place my stop loss somewhere, so in this area. There, the stop loss will be a bit too large, 61 pips, it's a bit too large. I can place it, for example, here. And if the price comes back on this level, or I can open the trade. So I will open the trade now. It's not too late. Okay, the price came back approximately to my entry level. So you can see that the trade is opened, and we have a stop loss size of around here. How many pips? 30 pips. So let me show you on the terminal panel this trade. So the size of the trade with the size of this account, which is a little more than $8,000. So the size of the trade is 42 microlots. And this constitutes, in fact, 2 units. 2 units. Each unit has a size of 21 microlots. And you will see that when I will have to make an MX, momentum exit, so I will close 1 unit. So I will not have the opportunity to make a scale-in because within maximum 2 hours, so it's extremely risky to consider scale-ins, and the best trend to make scale-in is when we catch a trade, and a trend starting around the London Open, so during the European session. And so let's see if we will have the price moving in the right direction with the pound Kiwi. It is possible, the trade is a bit risky because it is possible that the pullback is not over yet. And so this is why we must not be surprised to catch a first trade as a losing trade. And so to make an MX, I will use the MX button on my button panel, and to make the XXX, I will use the XXX panel. Now we have also a data panel which shows many data about the trade. I will explain just 2 lines, the ESL result and the XXX profit. The ESL result is in the column symbol, is the result of the trade we will get should the price hits the stop loss. So in this case, if the price hits the stop loss, we will lose 0.97%. And the XXX profit. And so this number will change when we will make an MX or when we will change the stop loss. And the second number is the XXX profit. For the moment, it is a green number, 0.10. So a green number is always changing. This is the result of the trade if we close the trade at any moment. So if I close the trade now, I will make a 0.1% profit. And so these 2 numbers give us the potential profit we are making and the maximum loss we can face if the price hits the stop loss. And so these are 2 evolving numbers depending on the way we handle the trade. And so, but they are very important because they help us to handle the trade carefully. Now, when I am in a trade, what I do very often is the following. So I define price level which correspond to half of the size of my stop loss. The stop loss was, let's say, 30 pips. So half of the 30 pips is 15 pips. I will add also the size of the spread. We have a big spread for the pound Kiwi. So 5 pips. So 15 plus 5 is 20. And so I will set a target profit at 20 pips. So here, at around 191.33. 191.33. So in this area. And so if the price reaches that level, just to show how the risk will evolve, making an MX and adjusting my stop loss. So this helps to show how the risk is evolving and how the trade will become safer. So if I look on the other pair, so we see that the Euro-US dollar has not made a pullback deep enough. Similarly for the pound US dollar and similarly for the US dollar yen. But the pullback is on its way. So, but now I have taken a trade on the pound kiwi. So let's focus on the pound kiwi. And this is where we need to be patient. And so why do I fix such a minimum profit level? So until a few years ago, whenever I had an exit setup on my chart, I was executing that exit setup because I am always a very risk-averse trader, very, very risk-averse. And so after a few years, having accumulated several thousand of trades, around between 3,000 and 4,000 of trades, I have decided to make a deep analysis of my trades. And I have begun to play some what-if scenario. And one of the scenarios has been the following. What my result would have been should have I ignored all the exit setup giving me a loss or not enough profit. And I have defined enough profit as a profit corresponding to half of the size of my stop loss. And then after that analysis, I have realized that my global profit would have been way, way larger. Of course, my losing rate would have increased a little bit, but not too much, and my total loss on these losing trade would have been a little larger than my previous losses, but my profit would have been way, way larger. And so this is what I call a discretionary situation when I ignore exit setups as long as I don't get a profit large enough. And this is a discretionary situation we can use provided so we feel comfortable with such a discretionary decision and we use a small risk per trade. So, okay, Francis. Yeah, it's extremely important to have a UPS power. I have myself a UPS power in case we have a blackout. So here, and the risk is very high this winter in France and in Europe to have electricity blackout. So, and my UPS gives me around 20 minutes of autonomy. So I have plenty of time to close my platform. Okay, let's see here. The price is reaching my minimum profit. So, and I will make an MX. So I have missed the MX, so let's see if the price will come back again. This is why trading with the max requires a lot of concentration. Sometimes if you miss a small detail, you miss a good opportunity. Like myself, I have missed the MX, so here I have not been fast enough, and it's not a surprise to see the price retracing, but I don't care. I will see if I will have another opportunity. But it would have been a nice opportunity to see how the risk would have dropped. The US dollar is still a very weak currency. The Kiwi has a good strength, not the best strength, but one of the strongest currency, as it has been the case for the European session. So we can count on that effect to see most probably the price coming back lower. But you can imagine the effect on the risk. So if I close one unit here on my horizontal blue line, so this means that the profit on one unit will be equivalent to half of the size of the stop loss. So this means 1/4 as a reward to risk ratio. And so we should see the risk dropping at least at 0.75%. And then I will also tighten the stop loss on an appropriate place. So we have specific rules to adjust our stop loss. We cannot adjust the stop loss as we want. We need to keep, depending on the volatility of the moment and the volatility of the pair, we need to keep a stop loss far enough from the price in order to avoid as much as possible to be stopped out too early with the volatility. And let me draw a white line here at the level of the stop loss just to remind the stop loss level. If I succeed to draw it approximately. No, I should not move it, of course. This is the problem with this stop loss line. Let's draw it here. Sometimes we have to fight with MetaTrader. Okay. So this white line represents where my initial stop loss has been. So, okay, Francis, good luck with your power. So hello, Ron, Randy, Alex in the private Max chat room. So now let's pay attention to what is happening in order not to miss any details. You can see that it is very easy to be distracted. Yeah, Alex, the pound Aussie is also a good pair to consider, of course, but of course I will not consider all the pairs. I have already 6 pairs on the chart. So the US dollar is again weakening. The pound is also a bit weakening. Hi, Micha, welcome. Yeah, the pound Aussie is often correlated with the pound Q, but not always. And we are for several months now in a period when the correlation is less good between the two pairs, because there are now some small differences in their respective economy. So pay attention to the less quality correlation between the two pairs. There are plenty of websites giving correlation between pairs, and so you can Google for that. And so this is something you can follow when you are in your trade. If you use a platform like TradingView, for example, which is a very popular platform now, so it's easy to show the correlation between pairs. If I see another pair moving, so I will consider also such another pair, just to have some more opportunities. More pairs we follow, more pairs we monitor, more opportunities we may have, of course. Because one specific pair may possibly not move in a satisfactory way. And so, but I'm checking on another monitor, so if I see something else on another monitor, so I will switch immediately to one of the other 5 pairs I have on this monitor. Let's see if the price will come back again on my level. And by the way, for those of you Max members who trade with the Max standard, you can see that this blue line is not also a random line. So not only it is the half size of my stoppers, but it corresponds also to an important level. You know, these dynamic support and resistance level we have in the Max. So, and we are right on this level, And so if we have, it's possible that we have a rejection of that level. If we have a quick look on the other pair, we can see that now the price seems to begin to range on the euro US dollar, the pound US dollar. Still not enough pullback in the US dollar yen. The price is ranging on the euro yen, ranging on the pound CAD. So we need to be patient. But I'm monitoring also these pairs on another monitor just to have a quick look, an easy look on these pairs. I'm working with 3 monitors, so I'm using my third monitor for these 6 pairs. Now, a very interesting line we have on the chart, on the main chart, is this blue and pink line. Blue line when the price is moving upward, pink line when the price is moving downward. These 2 lines are drawn with an indicator which is called the max price channel, and it is a line when the stop loss is above the pink line. This means that we are in a down movement, and so we are handling a short trade. This line is used to progressively adjust the stop loss. Of course, for the moment, my stop loss is below the pink line, so the pink line is not usable for the moment, but you can see that with the price moving downward, this pink line drops also. And so normally, if the trend continues to go downward, we should see the pink line going below the that red horizontal line, which is my stop loss. And so this pink line will be used as a way to progressively tighten the stop loss as long as the trend will unfold. And similarly, when we are in an uptrend, we will keep the stop loss so below the blue line and following the blue line to tighten the stop loss. So let's pay attention. The price seems to come back to my level, and so if it is the case, I do not want to miss it. The spread has dropped by 1 pip, so I can adjust my line 1 pips above, so at 34, so here, and let's see if the price will come back. The Aussie US dollar should be an interesting pair today. Yeah, nice spike in the Aussie US dollar. But we still have to wait for a pullback. Why the Aussie US dollar? Because the US dollar is the weakest currency and the Aussie is the strongest currency for the moment. So this is when the trend will resume. This is an interesting pair also to consider. Let me take a small sip of water. Okay. An example of exit technique with the store RSI, and this is a technique I have presented several times in our presentation webinar, is when we have a divergence between the price and the store RSI. You all know what a divergence is. For example, when the price is making higher highs, let's see if we have an example here, while keeping an eye on what the price is doing. So if the price is making in an up movement higher highs and the store RSI is making lower highs, so we have a divergence. This is one of the divergent type we have. We have 4 different types of divergence, and this, of course, is not a way to predict what the price is doing. What we observe is with a divergence, very often the price is making a pullback, and this is normal. Similarly, whenever the store RSI makes in a down movement a bottom, a low, this indicates that the price is in fact pulling back. So the technical indicator has never a predictive power, never, never, ever. So don't try to predict what the price will do with an indicator. However, it is often easier to pinpoint a pullback in the price with an indicator than with the price itself. And the fact that the technical indicators are often, oh, my connection has been stopped. Why? Let me check. I have my internet connection, so it must be a small disconnection in MetaTrader. So let me try to re-log in. Sometimes this happens. Yeah, the connection is coming back. Okay, so because an indicator is often normalized between a minimum limit and a maximum limit, and this is the case with the store RSI, which moves between 0 and 100%. So it is so easy with some specific criteria to define when the pullback becomes too much important. And this is how we consider the trade risk management. We will consider an exit setup, in fact, is a way to quantify when a pullback becomes too much important. And why is a pullback a risk for the trade we are handling? Because, of course, you see for the moment, I have a potential profit. Not a big one for the moment, because the price has not moved a lot since my entry, of course, but it is a potential profit. But whenever the price makes a pullback, a portion, possibly a large portion of this profit is evaporating, even if it is a potential profit. And the question is, what pullback lengths do we accept? And so our exit setup are all based on the same idea. What is the maximum pullback we accept before reducing the risk? So this is the concept behind our exit setup. We use several indicators, but never to try predicting what the price will do, but just to quantify when the risk along a pullback becomes too much important, forcing us to make a momentum exit, or with long-term exit technique to make an XXX, so to close the entire remaining open trade or open position, closing all the remaining open units. And when you adopt such an approach in terms of trade risk management, your vision of an indicator is completely different. And so when an exit setup triggers, sometimes you will have to make an MX, and sometimes not, depending what the price will do after your exit setup. I hope I will be able in the next 1 hour to illustrate that idea. So I see nothing else interesting for the moment in the other pairs. That's a pity. There is no the pullback yet, so it will take a long time, and probably the market will begin to range now until tomorrow with the Federal Reserve meeting. But let's see. Or sometimes the big boys take their time to decide how to handle their own position or to adjust their position. Now we have different ways to represent a price movement on our chart. The chart I'm using for the moment is a 5-minute time frame. We can trade, of course, any time frame we want, even the monthly time frame with the max. But this type of chart, whatever the time frame, is called a time bar chart. Each candle having the same time length, 5 minutes in this case. If we take the 1 hour time frame, each bar will have a time length of 1 hour. But we can use also other price representations like Renko bars, like constant range bar, like mean Renko bar, for example. We can use also tick volume bar chart. So we can use several types of representation, each one having some advantages, but also some disadvantages. And the point is, there is not an optimal price representation to trade an instrument, but some of them may have some advantage. Myself, when I trade in my live trade, so I use a constant range bar chart because the constant range bar chart so provides more details in the price action itself, in the details of the price movements. And if we have more details in the price movement, we have more decisions, opportunities for an entry setup or an exit setup. For our max standard members, so you can see that the price is moving between these two levels, which correspond also to two dynamic support and resistance level. So this means that the price is ranging for the moment between these two levels, and so any range should be broken at some point. We don't know in which direction, but because my bias for the pound kiwi is to the downside and the news has not changed my bias analysis, so my expectation is to see the trend, this range should be broken to the downside. I may be wrong, of course, because sometimes my global context analysis is wrong, or my global context analysis may be correct, but temporarily the price does not follow the context analysis. For some reason, it may be, for example, market manipulation. But sometimes I must confess that my context analysis is not correct, because I have missed information which was important for the bias, or I came to that information too late. So it is a difficult process to handle completely the global context. And what is a global context analysis? The global context analysis consists in analyzing several types of informations. The first type of information is, of course, the main driving factors of the market, the interest rates. This means the decision by the central bank. And more importantly than the interest rates, the market expectations about the next central bank decision. We all know that for the Federal Reserve tomorrow, the expectation is for a moderate interest rate increase, 50 basis points. So this makes the US dollar rather weak against the other currencies. A second set of information are what I call the geopolitical event. For example, is the situation between Russia and Ukraine still influencing the market? Is the situation between Saudi Arabia and China susceptible to influence some currencies like the US dollar, for example? Are the tensions between China and USA susceptible to change the evolution of the US dollar, and so on and so on. So this is the second type of information to analyze. So let's pay attention here for possible MX. I will try this time not to miss it. The third type of information is, so the news, okay, I make an MX. So I have made an MX, and so you can see that I have closed approximately, as I have explained earlier, 1/4 of my reward to risk ratio, so 0.26%, and you see how my global risk has dropped. This means that now, if the price makes a huge reversal and hits my initial stop loss, I will still have a losing trade, but only minus 0.22%. So I have divided my risk by almost 5. But the distance between the present price and my stop loss is 50 pips. I have an opportunity to tighten my stop loss in this case. And observe this number, minus 0.22%, which is the ESL result. Of course, by adjusting my stop loss, I will not change my XXX profit, because the XXX profit evolves with the price evolution. But by moving my stop loss, I will reduce my risk. And here, I will adjust my stop loss. I can adjust my stop loss in all this area between where it is now and this yellow moving average, which is called the momentum line, the Mo line. And so if I place my stop loss at that level or just above the Mo line, my stop loss will be around 37 pips. So pretty much similar to my initial stop loss. And let's do that. I will move my stop loss just above the Mo line, so in this point. So the stop loss has been adjusted, and you can see that now my risk has dropped to minus 0.05%. This means that I am virtually or almost break-even. And when we are break-even, we can completely relax on our trade. This means that even in the worst-case scenario, the loss will be insignificant. If I drop my stop loss just a little bit, you can see that I am almost break-even. And because the distance between my present price and the stop loss is comfortable, so around 33 pips, this means that now, if I have an exit setup of any kind, for example, with the store RSI, I can apply that exit setup. And if I have an exit around this area, I will be able to close my trade with a profit. Second possibility is to try to stay in the trade as much as possible until I get a long-term exit technique. A long-term exit technique calls for an XXX. It will be, for example, a trend reversal. The trend reversal is basically, not always, but basically when this slow bias green and red line at the bottom of the screen will change from red to green. So this will be a trend reversal. The trend reversal can happen in a few minutes, or it can happen in a few hours. We don't know in advance, of course. But if I try to stay in the trend as much as possible, so this is a way to catch the largest possible portion of the trend. So we have two opportunities, either to make a short-term exit and then later, if we have another entry setup, to take another short trade, or to wait until the trend reversal, or also what we call a trend exhaustion in the max standard or movement invalidation. So we have several choices to definitively close the trade, but here, due to the limitation of this session today, so I will take the next exit setup essentially here on the store RSI or on something else. So on the chart, because I have our max standard template in the other monitor I'm following through to just to illustrate that. And so you can see that the risk is now has completely disappeared now on this trade. And so once we are in such a situation. And very often when we take a profit at the half distance of the stop loss and we are able to adjust the stop loss, very, very often, so the trade will become risk-free. So we have here a risk-free trade, so almost a risk-free trade, but with a tiny, tiny loss. If I adjust my stop loss just 1 or 2 more pips, you see when it will be adjusted. So not yet. Sometimes it takes time to adjust the numbers. So these two numbers should be identical. The global number and the symbol number should be identical. The global column represents the result of the trade if we have several simultaneous trades on different pairs. I will try to see if I can. No, it doesn't change the number. Sometimes it takes time to update the numbers. Or perhaps the spread is increasing. Now here, if this candle closes as a blue candle, we can see that the store RSI will make a low. But this low will not be an exit setup, because we can see that whatever the price is doing, going downward or upward, the store RSI always makes lows at some point or makes highs. And so not all the lows in a downtrend are significant exit setup. We have also strict criteria to define when a low is an exit setup, in such a way to avoid taking unnecessary exits. This candle will close in 5 minutes, so it's a lot of time, so 4 minutes and a half. And if it closes as a blue candle, most probably it will be it will trigger another exit setup. So with the max standard, we have approximately 20 exit setups. Short-term exit setup, long-term exit setups. Many of them are similar, so very similar. So don't believe that 20, 25 exit setup represent a large number. Many of them are similar techniques, so which reduce the complexity of these exit techniques. And so this is why when we trade a small time frame like the 5 minute, even sometimes the 15-minute time frame, we need a lot of concentration to never miss such a situation when we have either an entry setup or an exit setup. And a consequence of that is we need to remember each of the rules, each of these exit setups technique. If we want to recognize an exit setup, we need to know what the exit setup is. Of course, what I have said is just a truism. But it's a requirement to never miss an exit setup. And the way the exit setup and some indicators have been combined in the max, the beauty of that is that, let me explain in another way. You see here in this area, we have a low in the price. And so it will not be easy to understand on this chart because we have only one indicator for the exit technique. But suppose we have 2 or 3 other indicators showing also momentum. The beauty of the way the max combine these indicators is the following. If for some reason we miss an exit setup given by one of our indicators, chances are almost 100% that one of the 2 2 or 3 other indicators will give also on the next bar or the following bar also an exit setup in such a way that it's almost impossible to miss an exit setup in a low the price is making when we are in a downtrend, and similarly with a high. You can see that now the price is doing a nice red candle, which gives us the opportunity. We are at 50 pips from the stop loss, so this gives us the opportunity to tighten a little bit our stop loss, but I prefer to wait for the close of this candle in 1 minute and 40 seconds, just to see where the max price channel will be and if it will help. I don't think so, but we will have the opportunity to tighten a little bit our stop loss. Of course, another way to close the trade is when your total profit reaches some limit. For example, a 1-to-1 or 2-to-1 real to risk ratio. It's up to you. So 1-to-1 real to risk ratio will be 1%. Because remember something. Let's suppose that through one or several trades, you are able to make an average profit, total profit of 0.5%, 0.5%. And you trade every day of the year, okay? Which is not necessarily easy. Don't get me wrong about that. But let's suppose you are able to make a 0.5% profit every day, and you trade every day, and you compound your profits. At the end of 1 year, you will multiply your account by 3. With just 0.5% profit per day. If you make on average, and this is whatever the number of trades you make per day, it may be 1 trade, it may be 10 trades. And let's suppose now you are able to make on average 1% per day instead, which is a nice result. Then at the end of the year, if you make no withdrawal and you compound your profits, you will multiply your account by 10, 12. So which is a huge, huge compounding of your account. So the candle has closed. Now the stop loss is at 60 pips. I can certainly tighten my stop loss a little more, but I will be prudent and I will set my stop loss on the more line. See, now making my trade as giving a guaranteed profit, a small profit, but a guaranteed profit. Now this candle is what we call, let me check if it is a long bar. The length of this candle is 39 pips, 22 pips. No, it's not a long bar. So a long bar is an exit setup, but it is not a long bar. But we may have possibly at the close of this blue candle an exit setup given by our Sto RSI. And so let's see if in 4 minutes we will have an exit setup, in which case I will close the remaining second unit. Let me show you in the terminal panel. Remember the trade size was 42 microlots. Now the remaining position is 21 microlots. And if I take in the account history, you see the trade has been closed, the unit has been closed with almost a $22 profit. So 1/4 of 0.26% exactly, a little more than 1/4 of a percent. Now, if you check on the other chart, you begin to see a nice retracement happening in the euro US dollar, in the pound US dollar, in the US dollar yen. So, which is what we have to do. So wait for significant pullback. It is not significant yet, but at least the pullback has started after around 1 hour. So it takes time. And when these pullback will be broken, you will have plenty of other opportunities to consider a trade for the rest of the US session, because now we are in the US session and we still have several hours for the US session. In the meantime, do you have some questions about what I'm presenting here? Let me check in the question panel. So if you have questions, feel free. Any kind of questions about the context, about the max. So the candle will close in 1 minute and 40 seconds. If it closes as a red candle, of course, the store RSI will not give an exit setup, but we will have another opportunity to tighten further the stop loss because the stop loss is far enough from the present price, which will help to lock a little more profit on the stop loss. And now you can see the potential profit is just 1%. So if you want to close your trade at 1% profit, so it's up to you. And you can say, okay, my day is over and I will do something else. We do not fix target profits in the max because the max is a trend following system. We want to catch a trend, a portion of the trend as large as possible. The ideal situation is to catch the trend at its very beginning until the end of the trend. And we have plenty of them along a week when we monitor several pairs. In fact, in the Max Standard course, I describe in great details a very important concept, which is called the true trend concept. The true trend concept is a specific type of trends with an interesting length, minimum 60 pips for many pairs. And so when we have a movement of more than 60 pips, 100 pips, 200 pips, so, and we are able to catch a very large portion of that entire trend with several scalings, so you can imagine the profit we can extract from that trend. We can see that in the meantime, this previous candle has closed. I can certainly tighten a little more my stop loss, and I will even put it below the break even. And now you can see that I'm locking minimum almost 0.3% profit on the stop loss, which is my horizontal red line. And so we can tighten progressively our stop loss that way. We have several rules. The general rule is to follow the pink line, so staying between 5 and 10 pips above the pink line. But we have additional rules when the size, the distance of the stop loss to the present price is way too large. We can follow the Mo line, which is this gold moving average. We can follow also this green line, which is what we call the training wheels. It is a 1 standard deviation Bollinger Band. So we have several complementary rules to adjust our stop loss. And you can see that it seems that my context analysis for the pound kiwi was correct. My bias since the London Open was going short with the pound kiwi, and indeed the pound kiwi has resumed, so the downtrend even before the news release on the US dollar, the US dollar CPI. And concerning adjusting the stop loss, I do that bar by bar because it is a bar by bar fight, and even sometimes a pips by pips fight until we get a risk-free trade or even a profitable guaranteed trade, which is the case so here with this trade. How is your pound Aussie doing, Alex? If you are still in the room, how is your pound Aussie doing? Good? Ah, fine. You remember that my initial stop loss size was around 30 pips. Okay, this was my initial stop loss place, 30 pips. You may consider that 30 pips is large, but the risk in pips is never the financial risk. What is important is the financial risk. And we need to have, when we day trade, when we trade a trend, we have to take into account the volatility of the pair and the volatility of the moment. And so we need to have a stop loss large enough to be outside the volatility. One way to have an idea of the volatility is to observe the length of the wick and the tails of the candles. And if we have both wicks and tails which are pretty much large, then we can have an idea that the volatility is high. So we need to keep a stop loss large enough to avoid, in the case of an increase of the volatility against us, to avoid to be stopped out too early. Because in fact the risk in pips is not important at all. Imagine you have a trade with one standard lot. For example, on the pound US dollar, the pip value is $10 per lot. If you have a 30 pips stop loss, your risk is $300 for one lot, $300. But for 1 mini lot, it will be $30 because the pip value will be $1 per pip. So with the 30 pips stop loss, your risk will be $30, the financial risk. And so this shows that the financial risk depends on the trade size. And so the problem is how to choose the trade size, whatever the stop loss size, in order to have a fixed risk. For example, 1% of the trading account. And we use the position sizing concept to fix our trade size depending on an initial stop loss and the financial risk. Now we have here a long bar. This is a long bar. The length is 39 pips. And when we have a long bar is always a good exit setup opportunity if the price retraces somewhat. And I will use here 13 pips. So on this level. So when we get a long bar, so we consider a retracement corresponding to one portion of the length of the bar. It can be 1/4 of the length of the bar. It can be 1/3. It can be 1/2 of the size of the bar. I like to use 1/3. So this distance from the low of the candle to my horizontal blue line corresponds to 1/3 of the entire bar length. And if the price hits that horizontal line, I will make my XXX, so which is the case now. So let's make an XXX. So my trade has been closed, of course, taking into account the spread. And you can see that I have closed my trade with a profit of 1.4%. So a nice trade, a nice result, and a rather fast trade. Consider what has happened today after the CPI report release. So a long bar is always an exit setup we have to consider, because 2 out of 3 times a long bar is always followed by a pullback. Sometimes it will be a small pullback, sometimes it may be a trend reversal, and 1 out of 3 times, so the long bar will not be followed by a pullback, but the price will continue. So in which case we call it a momentum bar.